But let's also welcome on board Indranil Sengupta, economist and head of research at CLSA India. He joins in on the show right now. Indranil, hi, morning. Good to have you on the show. Indranil, after the googly from the governor yesterday, what is it that you're working with in terms of an assumption? What happens next? How many more rate cuts? What are the inflation projections?
Well, we obviously had rate hikes, but although yesterday's timing was a surprise. We are looking at another 100 basis points of rate hikes, which takes the terminal repo rate to 5.4% in FY24. As far as inflation goes, we are around 6% average for this year. I think it's not so much inflation as the fact that the rates are too low. That is the issue, which is why you have negative real rates. And of course, once the Fed starts to hike, all emerging market central banks, including us, the RBI, have to follow suit.
Um, so Indranil, 50, 40 bips, not even 50 bips, may not do the trick. Another 100 is coming. What are the chances that Reserve Bank of India, in its attempt to control inflation, in Hindi what we say महंगाई, and our viewers can connect with the word महंगाई, they may actually just do a damage to the economic recovery which happened after the COVID?
Well, number one, we are actually seeing 80 basis point of rate hikes over a month because there was a 40 bip hike, de facto 40 bip hike even on April 7th. I think that all over the world, central banks are being pushed into a situation where you have to sacrifice some amount of growth to bring inflation down, and we are no exception. So we think there's another 25 bips downside risk to our forecast of 7.1% FY23 inflation.
A lot of experts have spoken to Indranil. They are saying that look, we are in for a repeat of 2011 and 12 kind of a scenario, which is low growth for long and high inflation. And then we saw a collateral damage to the economic growth. It led uptick to a NPA cycle and it broke down the entire so-called feel-good factor. I hope we are not there yet, but what are the chances that the cycle may repeat itself?
So I think a lot depends on where the US goes because as of now, our base case is that the US growth slows down to 1.3% next year from around 3% this year. If the US were to slip into a recession, that impacts India's growth by 150 basis points. So as of now, we are looking at a 5.5% growth for FY24, with a US recession that can go to 4.1%. As far as the scenarios of 10 years ago are concerned, I think number one, at that time, again the RBI had waited and the market was kept on saying that the RBI should be hiking. I think this time the weight is much lower. The RBI has already reacted. And secondly, now we have sufficient FX reserves to control, imported inflation, something that we did not have at that time.
So is that what you would like to see, that kind of action, the jugalbandi between the government as well as the RBI to turn towards the Forex reserves? This argument has been made since 2020.
That the RBI should be raising FX reserves. I think the RBI should be raising, as much of FX reserves as possible. We are looking at a possible hike in the NRE or the FCNRB deposit rate. Because remember that it's just not the Fed is hiking. They will be withdrawing liquidity, 47.5 billion right now, and then $90 billion every month from September. So FX flows are going to be hard to get, which means that you have to strain every nerve to hold on to your FX reserves and build on them.
Indranil Sengupta, from the market's perspective, historically what we've seen when rates go up, banks do well, staples do well. But this has turned out to be a DII's market, right? A domestic investors market, the way the foreign investors were pressing in with the kind of velocity that they were selling. The rate hikes that are taking place here, more that will take place. How do you see that impacting flows?
So, I think there are three ways in which the Fed affects markets, Indian markets. The first is, of course, the spillover of liquidity. When the Fed puts in QE, we get money. When they do QT, we don't get money. Money flows out, something that has been happening. The second is the expectations factor. And if you see the correlation coefficient between the RBI between the Nifty and S&P is somewhere close to 0.96 over the last 17 years. So eventually, Indian expectations and indeed expectations all over the world are largely set by what happens to US markets. The third is that, the relationship between Fed hike, growth and markets are not linear. If the Fed is seen to be sounding the all clear, saying that, okay, there is recovery, now I am normalizing monetary policy, you see Fed hikes sit with growth, sit with rising markets. Maybe, rates go up, but then you are making much more, in equity returns. When the Fed fights inflation, then it's a very different story because, then, that goes and damages growth. And I think the concern is that if you go and look at the data for the last, maybe 50 years, you find that no bout of high inflation in the US has been resolved without a recession. And like I was saying that, if there is a US recession, that impacts India by 150 basis points of GDP. So yeah, we have to wait and see how the Fed goes and to what extent the Fed goes, and what does to U.S. growth, because as of now, U.S. is the only engine of growth in the world.
Okay, so what you're saying then, Indranil, is that we are very much, not an island in this globally connected world. And I'm just quoting the governor's words from yesterday. If the Fed does move, we're bound to shake as it is.
Yeah, I mean, when the US sneezes, the world catches a cold. We are relatively more immune, because we are largely a domestic-driven economy, and the fact is that Mr. Das has built up high FX reserves. But yeah, I mean, when the Fed hikes, no central bank, no emerging market central bank can, avoid following it. And if US growth slows down, it is going to slow down global growth, India's growth as well.
Okay. So, Indranil, in your assessment, how high you think the 10-year paper could go? I mean, are we looking at 8.5%, 9%, or that would be a stretch?
I think over the year, and this is something I have been saying for a year, the 10-year will settle somewhere around 7.5%. I think that on the one hand, the RBI is hiking. On the other hand, if you have FX outflows, then the RBI's room to buy government paper through OMO is also going to rise. The very fact that they did a CRR hike will also add to their ability to buy government bonds. And I think that if they extend the HTM limit hike to say FY26, they may get more money going into uh, into uh, into bonds. Uh, So yes, I have been bearish bonds, but I think if you see major FX outflows augmenting the RBI's ability to buy, through OMO, then we don't really see yields like fly off the handle.
Right. Okay, Indranil, great to have you on the show, and we'll talk again when the
Sure.
RBI hikes. Hopefully, at least it will not be an out of policy move next time. Okay.